Picture a world-class industrial powerhouse running at maximum physical capacity, while its actual financial returns are rapidly dimming. Over the past year, this company has seen its profits collapse by 63%. The company is HEG Ltd. They are an established industrial player and a cornerstone of the long-standing LNJ Bhilwara Group. Their primary business is highly specialized. They manufacture the massive graphite electrodes required to operate heavy-duty steel furnaces. The physical footprint here is massive. They operate the largest single-site integrated plant of its kind anywhere on Earth, and they export 70% of everything they produce. This graphic breaks down the disconnect between their physical reality and their balance sheet. On one side, the world's largest plant drives massive exports. On the other, a 63% profit drop. This conflict forces a choice: dangerous value trap or short-term breakout. A massive industrial footprint guarantees production, but it does not automatically guarantee capital efficiency or shareholder returns. To figure out what is really happening, we must isolate the company's fundamental financial health metrics. The first major red flag is capital efficiency. HEG's return on equity has fallen to below 5%. That means the company is currently generating less return on the money invested in its business than a standard risk-free bank fixed deposit. We can quantify this disconnect by calculating the Graham number. This is a strict mathematical formula used by value investors to determine a stock's true intrinsic worth based on its earnings and book value. This scorecard shows the output of that calculation. Based on their current fundamentals, the intrinsic Graham number for HEG is exactly 334 rupees. The problem becomes obvious when you look at the current market price. The stock is currently trading around 629 rupees. That gap means you're paying a 46% premium over the actual mathematical value of the underlying business. From a purely fundamental standpoint, HEG earns a grade of D. There's absolutely zero margin of safety for a buyer at these levels. Tying up capital right now, simply because of the company's brand legacy or physical size, means ignoring the math of an overvalued balance sheet. But if we step away from long-term fundamentals and look strictly at short-term market psychology, the data tells a completely different story. This is HEG's current price chart, and it is firing off immediate buy signals. The current price has decisively crossed above its 50-day exponential moving average. It has also broken above the 200-day average, confirming that the broader price momentum is shifting to the upside. Looking at trend indicators, the MACD is flashing a strong buy signal, indicating that the upward momentum has structural support. The Relative Strength Index confirms this as well, mapping out a steep and aggressive upward trajectory. Most importantly, you can see a massive spike in trading volume right at the bottom of the chart. That indicates major market participants are actively accumulating the stock. You have a flurry of extremely positive, aggressive technical indicators actively fighting against the bleak fundamental reality we just calculated. In the short term, sheer buying volume and technical mechanics have the power to completely override long-term financial gravity. To understand why the fundamentals are dragging while the technicals are spiking, we need to zoom out to the macroeconomic environment. Domestically, HEG is locked in a constant battle for market share with their primary rival, Graphite India. It operates like a localized duopoly. But the core threat to both companies comes from outside. This snap illustrates the pressure from systematic dumping of ultra-cheap graphite materials originating from China. When artificially cheap supply floods the market, it compresses HEG's profit margins across the board. Against a sovereign pricing strategy, having the world's largest physical plant offers almost no defensive advantage. As long as geopolitical pricing wars dictate the final margins for these materials, long-term predictability and safety in this sector remain essentially impossible. All of this leaves HEG perfectly split down the middle. It is a textbook case of fundamental decay facing off against aggressive technical momentum. This decision tree maps out how to handle the stock right now. If your strategy is a long-term value investor, follow the branch to the left. The instruction is clear. Completely avoid the stock until the company's structural profitability actually recovers. But if you are an active swing trader, you follow the branch to the right. The technical momentum creates a viable short-term opportunity. The data suggests a precise entry window right around the 625 to 630 rupee level. Because of the underlying risks, you must set a strict, non-negotiable stop-loss exactly at 610. That stop-loss is critical. Because HEG holds a fundamental D grade, there is no intrinsic value safety net below to catch the price if that technical momentum suddenly fails. If the trade holds, the target exit zone for taking profits sits clearly between 670 and 720. Before making any moves, do your own homework. Look up the return on equity for their main competitor, Graphite India, and drop that number in the comments so we can compare their capital efficiency directly against HEG. Remember, executing a solid technical trade on the wrong personal timeline will inevitably destroy your capital. Always align your strategy with your actual risk profile and consult a registered financial advisor before putting money on the line.